Hello, everybody. My name is Dr. Michael Kelly. I'm a senior consultant working at Wolfram Research, and I specialize in finance. I was previously a professor of computational finance at the Illinois Institute of Technology, and before that, well, was an Australian. I'm an American Australian now. So I used to work at Sydney University and other places like that. And this is the talk that I'm going to be giving now. It's primarily about the optimization of portfolios and investments. It's a follow-on from a previous webinar that I gave. And so we're assuming at least an intermediate knowledge of mathematics and some knowledge of finance as well. So without much ado, let's go in and then look at what we're going to do here. So basically, I'm going to look at portfolios and I'm going to look at optimization. So optimization is built in a big way in Mathematica. So perhaps just if we go in and look at optimization now, you'll find that we have a number of functions for dealing with this. We have super functions like n maximize and minimize, and we have functions to do with convex regions, called necessarily convex optimization. These are the ones that we're going to be using in finance. Why? Because you're going to have a restricted class of choices that determine the region in your space of allocations that will define your portfolio. They're going to be either linear in structure, or they're going to be linear fractional, that is to say, the ratio of two linear expressions. But as you know, most of the time, what you're doing in finance with portfolios is you're trying to minimize the risk while maximizing your profit. Risk is expressed as a double dot in a product. And so we'll be using quadratic optimization. Now, but I'm going to have additional constraints quite often. These additional constraints will determine, again, I will have to have a limited area in the solution space that allows for this. So I'm going to, for these additional constraints, I'll be using second-order cone optimization and conic optimization. Conic optimization, notice it specifies lower bounds, whereas second-order cone optimization specifies upper bounds. We'll look at the conditions under which these apply, but all of them have the same type of structure. Namely, I will just be using this type of structure. All of them really do minimization. So I'm going to be looking at a particular function. Usually I'll be trying to minimize some function of return and risk, which I'll want to minimize, given certain constraints, and then I'll have to specify the variables. So let's go in now and just look at, let's get an idea of what's happening here. If I wanted to, look at, say, 10 constituents from the S&P 500, here are their tickers. And what I'm going to do then is apply the financial data function, which is inbuilt in Mathematica. The syntax is always given by this structure here. It tells you the different ways that you can use the function. Notice function application always uses square brackets. So I'm going to be looking at the closing prices over 2013 and map them now onto this. I'm suppressing the output here because it's just be lots of information. All we need to know is that this is these are the tickers that we're using, these are the values that we're getting back, and then we can look at it. And I just put it into a plot. Notice I'm never using more than 1 or 2 lines of code and just going through this in a step-by-step basis. So here are the various functions, or rather the stocks that we're looking at. And now I'm going to make an allocation for these 10. Okay, together all of this will add up to 1. Now, we'll come back to this later on. Where did I choose this from? Well, that's going to be the whole point of this exercise. How do we choose the allocations? We will choose them in a way so as to optimize our return. So once I've got my allocation, a simple dot product. Okay, for those of you who've done some maths, a dot product is merely, so this here, when we go on to this, is a vector, and each of the elements in this are vectors, and the dot product of the two, this is going to be the sum of the allocations for each of the stocks. So this will define our portfolio. Okay, now each of them was a time series object, and this is time series thread, which allows me to take each of these time series here and then form its product with the allocations to give me a time series product at the end. So we're going to look at this in a moment. I'm going to plot it again, and I'm going to have an inset here, which is going to show the allocation. And this is the picture that you see here. And that was how it was created. So all that's happened here is that I've joined together a certain amount, and as you can see, as I move my cursor over the pie chart, it tells you that I've put 11% of Exxon, 14% of Apple, and so on, has gone into the creation of this portfolio. Now, in Mathematica, I won't go into this. This is another topic to be done in another webinar. But once I've got my portfolio, I can smooth it out. And I do this because if you go back and look at the portfolio previously, you'll notice that it's using some resampling, but the point is that for different stocks, they don't always align on the days of trading. And so we won't have uniformity in the trading events. But if I want to build a model for this, then they need to have temporal regularity. Otherwise, it's going to be like comparing apples with oranges. So that we have an inbuilt function called time series model fit. And what it allows us to do is to take in some data. I can specify a model, or it will just come up with one. In this case, it tells me that this can be approximated by an autoregressive integrated moving average called an ARIMA model, okay, with 1 degree of differentiation. Now I can use the forecast function. It takes the model that I have, and I say I'm going to go 7 days, 1 week into the future. And then I could put my portfolio and the forecast together, and we can see that it says in this particular case, okay, that this was actually a reasonable allocation because we're going to be improving as we go into the future. So, but the whole point here is, where do I get this allocation? I've just arbitrarily assigned these numbers in this case. But if we really want to work this out, then we have to use optimization. And these are the various forms of optimization I'm going to be looking at. So let's go in. Let's look at the simplest possible case. So here's our data. I've got it in a table. So what we're going to be looking at, of course, is the allocation of assets in the portfolio. We want to minimize the amount of volatility while increasing the expected, the overall returns. Okay, so here we've got 10 different assets, 3-month treasury bill, long treasury bonds. We've got some indexes, bonds, NASDAQ, and gold, for instance. And the returns here, they're to be interpreted as, so in this case, in 1973, the S&P 500 dropped. And in fact, it lost 14.8%, while gold appreciated. You often find this relationship. If the market goes down, gold goes up, because people then think that the risk is rather high. They tend to go into expensive valuables like gold. So here I've got this is the time series. This is for each of the bills. Let's put all of these values in now. So I'm going to convert each of these columns. A column is associated with each of the instruments. into a row. And this is now our list of returns. I can go in and ask about it. What are its dimensions? Okay, so there are 8 stocks, and we're going over 22 years. Now, I can get the expected returns from this. So again, taking the transpose converts these rows back to columns associated with each of the 8 instruments. And so I'm going to get the expected returns for our 8 instruments here. And I can use the same thing. We've got a covariance function. Notice these are all built-in statistical functions in Mathematica. And I can get all of the covariance here. We can get a picture of this rather than the numbers to see how it's going and what is the overall structure of our array of covariance. Now, what I'm going to do now is use a function, a simple one, called find the minimum. What I want to do is minimize the overall standard deviation of the allocation. Okay, and so I want to look at my variables. So here are the names for our 8 instruments. What I'm going to do is let X be a vector, and I'll put the names as subscripts, and here they are. And the other thing you need to know, of course, is that I want to, all of this, these will represent the amount I will invest in each of these instruments. And so the total amount must be 1. I want to minimize the overall volatility. This is the dot or inner product of the variables with the covariance. I'll come back to the mathematics of this in a moment, but this is really a double sum. Now, the other thing we want to do is we want to specify some type of overall expected return. Let's say 12%. So this will be, we've already got what the expected returns were. Here they are. But once I've chosen a particular allocation determined by the variables, then my allocation or expected return or profit is going to be given by this dot product, and it must be at least 12% or 1.12. Now, the other thing I'm looking at is there's no short sales here. So all of my allocations must be positive. So all of my variables must be greater than 0. I'm going to thread over all possibilities for this, and it holds for all of them. So I'm going to apply AND. So I wouldn't worry about this so much. It's just saying for all of the instances here, all of the variables are going to be positive. So here is the thing, my objective function. These are my constraints. And then lastly, I specify my variables. And it comes back with this. It tells me what is the minimum value I'm going to get for the volatility, or the standard deviation, and what are the allocations for each of the instruments. Some are going to be essentially next to 0. Okay. Now we could put in, this makes it very easy. Suppose that I wanted to decrease the volatility, but the expected returns are only 10%. Okay. Then this dot product is only going to be 1.1 in value. And we see here, okay, that if you go back to the gold, for instance, okay, we're only getting a 10.2 or 10.26, 10.3% investment in gold, whereas previously it was 20.4%. Now, what I've done here is specify a weighting or allocation associated with each instrument. But it's much easier if we think in terms of vectors. So let's go back to a slightly simpler case here. Okay, so here I've only got 2 things that I'm investing over a number of years. Some Treasury long bonds and the S&P 500 stocks. So here each of my two instruments over all of the 2 years. Again, I get, by taking the transpose of the returns and its mean, I get my expected mean returns and the covariance function. And in this simple case, this is what the covariance function now looks like. Okay, these now, I've only got two variables that I'm going to deal with, and I'm just going to give them one name. So this is a vector of length 2. Now, this is for those of you having a little difficulty understanding when I talk about volatility being a double inner product. If you think the risk is going to be the sum of the product of the weights, so associated with each stock choice. So for stocks I and j, it will be xi and xj, multiplied by the covariance between these two stocks, sigma ij. And then we sum them up over all values of I and j. Okay, when we do this, this is this double product we get, but this is the same thing as this. So this double inner product is a measure of our risk, or is what we're defining now as the risk. So I can rewrite the entire problem from beforehand in a much shorter notation, and we'll be using vectors and matrices now. Vectors to represent the expected returns, matrices to represent the covariance or the correlation. Again, the total investment must be 100%. This is going to be the returns for that allocation. In this case, it must be have an overall return of 10%, and all of my values here must be positive. And with that, I can get what is the minimum variance, and these are the optimal associations, or sorry, optimal allocations. So all of the problems we're going to look at are going to have that type of structure. In all of the cases now, I'm just going to randomly generate through basically 6,000 simulations, depending upon, let n be the number of stocks we're going to look at, and it will then generate from this time series the mean and the covariance, which in the future we'll always call mu and sigma respectively. So here I've got 6 stocks, and the covariance is going to can be represented visually by this array plot. So again, let Wi be the percentage of the total investment made in stock I. So the total return is mu dot w. And again, it's the same type of argument about the risk. The risk is a double inner product of your weights with the covariance. And this is the same as this double sum. So our return, which is what we want to maximize, and the risk, the double inner product, is what we want to minimize. So let's now look at how this changes when we increase the number of constraints. Now, starting with, we're always going to be trying to minimize the risk. Okay? Then the double inner product forces us into a situation where quadratic optimization is the best approach to use. Suppose I put some additional constraint on the weights and the risk. Then I'll have to go to second order or second order cone optimization. And then finally, suppose I take into account some other constraint which relates to the way the weights or the allocations are going to be distributed. Then we're going to be using ConicOptimization. So let's look at these 3 situations. And at each time, we can go here and click on this to see how the each of the optimization works. So I won't go into all of this here. We will be using vector notation. So these, when we have normal less than or equal, greater than or equal to, we have this small curly values here associated with vectors and matrices. So there is this difference, and we're going to be working in that domain of vectors and matrices. So again, what we're going to be looking at now is we're going to, of course, this whole webinar is going to be about, I'm going to introduce constraints and how complex can I make them, what functions are we going to use in Mathematica to deal with that. So the risk now is going to have a risk aversion parameter. We want some way of attaching to the risk a measure of how averse we are going to be to taking the risk. So our objective function now, remember, is that it acts as minimization. So we're going to be minimizing the negative return, that's maximizing return, and minimizing the risk, okay, with a risk parameter. The weight constraints, it's no short sales, so the weights are all positive and they add up to 1. So now we're going to go do quadratic optimization of the objective function. So we've got an additional parameter here. We've got our weight constraints. And now remember what we're using here is that I want to get back the risk and return. And they're both functions of W, the weights. So W is the variable here, and it's a vector. Now, we've also got alpha, which is a parameter. So I need some values for alpha. So I'm going to set up a table, okay, for each of the values, for a range of values of alpha. These range of values, I'm going to start at next to 0, okay, and go up to 3 in increments of so there's going to be 100 divisions in this, so 100 possible values. And I'm going to solve it then. Now, what do I get back? I get back a table made up of pairs of risk and return. This is going to define a frontier. It's called the efficient frontier for this portfolio. And it will give me a range of values I can choose so I can offset the risk against the return. All right, so I want to look at all possible values that W could take, not only the sensible ones given by the frontier, but the silly ones chosen arbitrarily. So again, I'm going to get another table of risk and returns for different values of W. So this is going to be the different values of W. Basically, I'm taking any random values between 0 and 1. I'm going to do 6,000 simulations for 6 different stocks. And of course, they must all be fractions. That's why I've written it like this. If you're wondering about these things, okay, what is this hash and ampersand? An ampersand here in Mathematica represents a pure function. It is essentially the lambda calculus in Mathematica. Hash represents any argument. So this is applying a function, mapping it on to this thing here, which is a massive matrix, and creating a list of fractions for me. But they're quite arbitrary. Now I can take the frontier and our all of the other random portfolios and stick them together. Essentially, I've got 2 list plots, and I'm going to join them together. For the random values will be in red, and the frontier will be in black, and it looks like this. So we can see that as the you've got this bunching here. Okay, you can take, if you want to get a very high return, you can go out to here, but your risk increases enormously. The idea is to choose some sensible payoff between the two, and the optimal choice will not lie inside here, but on the frontier. So let's get a better assessment of all of this. Beforehand, I only had 100 choices. So let's choose, we've got about 6 choices here for the risk aversion parameter. And again, I'm going to do quadratic optimization. And I'm now going to return triples. The alpha value, the risk aversion parameter, the actual measure of the risk, and the W vector. Okay, and so as I do this for all of the possible results, but it's basically how I want to set this up. And so I'm going to create a bar chart. We're going to get our results. We want to go through all of our results, but only look at the last one. In other words, the last value here is our W vector. So remember, it's a vector of length 6 corresponding to the stocks, and I'm going to use a color for each of the stocks. Okay, and we're going to see now, as I change alpha, what happens to the overall allocation. So when the risk aversion parameter is quite low, okay, then in other words, we're not really interested in the risk, then what we'll do is we'll just go and choose stock 3, which is the one with the greatest return. But as we become more and more risk averse, then we'll realize that we're essentially putting all of our eggs in one basket. It's great when it's going up, and then it's terrible when it's going down. So you don't want to be in that situation. As I become more and more risk averse, I'm more inclined to weight my allocation in such a way that my income flow, if you're a full-on capitalist and you're only working for yourself, investing in the market, then what really matters to you is a steady income flow. And so as I become more and more risk averse, then I'm going to get more and more of a diversified portfolio. And it's going to be one in which finally at the end, I have various allocations for all of the stocks. So, and we can go and look at this directly to see what's happening. Again, as I increase the risk aversion, then of course my return will drop. But it's not going to drop by much. And for this small fraction in change, I get much greater stability and I reduce the probability of loss. Now, all of the other problems in this group are of the same type. The risk is the same, but I'm going to introduce an additional constraint or a number of constraints. And as I do so, then I must, ramp up the type of optimization. So here, I'm going to be putting an upper bound on the risk. Now remember, the risk is this double inner product. This is a vector, this is a matrix, and another vector. So the risk is itself a vector. So S must also be a vector. Okay, and my objective function now changes. Beforehand, I just had the risk in here, but the risk is bounded above by S, so it's sufficient to put in S here. Remember, I'm minimizing, and if I'm minimizing the negative return, I'm maximizing the return, and about I'm minimizing the alpha times S, where S is the upper bound for the risk, and alpha is our risk aversion parameter. The weights constraint remains the same, so everything is the same as beforehand. What we're seeing now, again, we're going to have the same structure. So it's essentially the same idea as before. I've got an objective function which depends upon the parameter alpha. So I set up a table for different values of alpha. I put in my constraints, but now I've got two variables. Okay, not only are the weights W, but also S. Okay, which is the upper bound for the risk. So I've got to solve for both of those. So this result here, when I get the, it will give me two vectors. It will give me two lists that will say what are the values, or two sets of rules, a set of rules for W and a set of rules for S. Now I substitute them in and evaluate the risk and return. And as before, since these are the ones that are optimal, they will fall on the frontier. Then in the same way as beforehand, I generate all of my random values and plot them up, and we'll get a similar approach. In fact, almost identical behavior as beforehand. And again, what I can do here now is for a much smaller range of the risk aversion parameter, just set up a particular set of values here, get the second order result, and substitute it in so I get a bunch of triples associated. So I'll be maximizing my return. At the same time, I'm choosing particular values of alpha, and I want to find out what is the corresponding weights for each alpha. That allows me to go in again and for the results say, all right, what I want to do is for the 6 stocks that I've got here, I want to go into the results here, but only for each of the, for all of them, look at the last element. The last element are the weights, okay? And these will then go into a bar chart. The bar chart will tell me how much of each of the 6 stocks are associated with each different value of alpha. And again, we get a very similar situation. As you become more risk averse, so your portfolio becomes more diverse. If you're least risk averse, that is very risky, you'll just choose the stock that has the highest return and stick with it. And again, we get the same or very similar result for the same idea. As your risk aversion goes up, so your return is going to drop, but not by much. By choosing this situation here, you might get a greater return until everything changes, and then you'll get the greatest loss. Now, this is what you traditionally get told, and all of the models I've just shown you are very common in the literature. But they're not realistic, because what happens, particularly if you're a market maker, so you're one of the big boys, you're a bank, you're a hedge fund, then your behavior will affect the overall market behavior. And this will then, so you get a feedback mechanism. And this feedback mechanism means that will induce another constraint on our problem. So we have the situation from beforehand, the risk, and also an upper bound on the risk. So this is our risk constraint. Our objective function remains the same, but now we look at that there are going to be these market effects as a result of buying and selling. So it's been shown that the effect of market prices due to buying and selling of stocks now results in this type of change. So it induces an additional variable, which we'll call T. And it basically says that there's going to be a negative side effect of this, a loss or a cost associated with your interaction with the market. So, and this interaction effect is basically for each allocation that you make for stock J is going to be the absolute value of that stock raised to the power 1.5. And then I add up for all of my investments. So I don't want to go into this, but basically the maths behind it is that you're looking at the power cone associated with the epigraph transformation. So your allocation function is a function in a 6-dimensional space in this case, and we're essentially looking at the region of space just above it. This is called the epigraph transformation. And so our optimization now requires ConicOptimization. So we now need a constraint associated with the market, and it's going to be this function here. So I'm basically saying, let's take W subscript I, its absolute value raised to the power 1/5. That's what we're seeing here. And I'm going to associate it with a vector T. So the ith element here is going to be less than or equal to the ith element of the vector T, and this holds for all 6 stocks. So this is a new market constraint. And now our weight constraints change. Because W is no longer going to add up to 1, we also have to take into account the effect of the market, how this the market constraint effect. So this is going to be the total value for t multiplied by 0.1, and the sum of those two will give us 1. So you have this feedback effect. So now it'll be just like before, except we're using ConicOptimization. Our objective function remains the same, but we have these market constraints. And now our variables, we've got 3 sets of variables. We've got the allocation variables, W. We've got the upper bound to the risk, and we've got T, which represents our upper bound market constraints. Again, we choose, because alpha is a parameter, we'll have a table for a range of different values of alpha. Once we solve this, we substitute it in to get our pair of values for risk and return. This is a table of these pairs, so they identify points in a 2-dimensional plane, which is our frontier. And in the same way as before, we now generate some random risk values. That's a little more complex. I don't really need to go into this, just to say this, that basically we want to generate, again, there's going to be 10,000 simulations for each stock of the 6 stocks. But they have to satisfy this additional complexity, that they must be ratios that basically satisfy this type of epigraph transformation, and namely this thing. Okay, so for each of these, I generate 7 values and then substitute them in up here. And so this now, because there are 10,000 and they, anyway, we're going to get a much better result. Okay, and you can see it covers a much wider range. And again, here is our frontier. And you will choose the optimal portfolio will be on this frontier, depending upon how you want to trade off risk against return. So what I can do is specify again a short range of values for our risk aversion parameter, solve the whole thing again, and basically what I'm getting now again is a triple. In the triple, I'm getting the aversion parameter, the value for the return. Notice this can generate a few error messages, because you can occasionally be outside the range that's appropriate for the conic optimization. So what I want here is not only the weight vector, but what it doesn't cover. Okay, and so this will create a new 7-dimensional vector as the last element. So now when I go in and I look at this, there's going to be 7 values, 6 for the portfolios, and then the cost, the market costs, as a result of buying and selling in a large way. So this now has a quite, a different result altogether. When I'm less risk averse, actually leads to greater diversification in my portfolio. And as I become less and less risk averse, so the effect will be that there's going to be more and more market costs involved, and that will take up more of the overall allocation and begin to dominate. So this is really an unintuitive result, but this is the type of situation you're going to be in if you're a bank. Does this actually occur? Yes, indeed. Just think about what happened to Bank of America in the 2008 financial crisis. And in fact, Bank of America continued to make disastrous choices in its portfolio for the period, for long afterwards. Probably, I don't know what type of quants they have there, but they're the ones who should be looking at examples like this. Okay, so let's go and look now at other types of problems. Again, maximizing return, minimizing cost. But if these constraints are linear, then I can use the LinearFractionalOptimization tool. Now, my constraints are going to be basically the ratio of 2 linear constraints. Okay, so I've got $250,000 of capital. Let's look at the simple case. There's only two stocks, and they're a bond and no, it's basically three. There's two stocks and a bond, so there's three altogether. Let XI be the amount I'm going to invest in each of these. So there's a capital constraint. I've got an upper bound of $250,000 to spend, and so the two stocks is a utility stock and I think later on here, an electronic stock. The utility stock gives a 9% dividend. So that's going to be X1, and I can't spend more than $40,000 on it. The bond, however, so he's being a bit risk averse here, saying, okay, I'm going to put at least $70,000 in the bond, but it only gives me back 5%. And then there's a tech stock, electronic stock. Let's look at this problem. So our total investment then is going to be the sum of the returns I get for each of the investments multiplied by the amount of that investment in each of the three instruments. This is the total cost. And so now I've got a linear fractional optimization. What I want to do is minimize this ratio. So in other words, I'm maximizing the profit, minimizing the cost. And I've got a capital constraint. I've got a constraint for the utility stock, for the bond, and an overall investment constraint. And I'm trying to solve. Now this, by the way, is no longer a vector. This thing here is a vector, but each of the elements x1, x2, and x3 are scalars. And this is the answer that I get. Remember, it always returns a list of rules. So now I can substitute that in to find out what is the total cost and benefit, because remember, the total cost and the total profit are all functions of the xi. And what is the yield? Well, that's the I'm going to substitute the result into the ratio of the profit to the cost. Okay, so we're getting an almost 6% return on that. Let's introduce an additional, so we are basically going to express the whole thing now again, but go put it back into vectors. Okay, find the optimal combination of investments that yield a maximum profit, minimizing cost. We've got the net present value and the cost associated with our 4 investments. We're going to solve this problem using a decision variable. So if so the question here is, we already know what the value is, what the costs are going to be, which ones, so that we maximize our profit while minimizing cost. Okay, so we've got a decision variable. Xi now takes a value 0 or 1. It takes a value 1 if we select that, that stock to invest in. Our objective function again, remember, these are our net present values. I need their dot product with the xi, because my actual costs will be which ones I invest in, and my actual value again is going to be which one I invest in. So if I don't invest in, say, the first and the third, then the x1 and x3 will be 0, and I'll only get how much the value of investing in the second and the fourth stocks. X must satisfy a binary constraint. Basically, it's 0 or 1. And I've got $14,000 overall. So my costs are bounded above here. So I now put in the objective function, which is this ratio. And I've got 2 constraints. They all depend upon x. And now x belongs to the set of vectors of length 4 whose elements are integers. And we can solve for that. So basically it comes back and says only buy the second stock. And the reason for this is it has the highest value with, relatively speaking, the lowest cost. Okay, so this is a question about investments. It's not a question about, notice time was not an important part here. So this is a static problem. Okay, this is a problem more related to business than sort of associated with a company than related to one of investment and portfolios, really. So again, this is going to be, I'm going to add additional constraints. Previously, we looked at problems with no short sale. We're now going to allow short sale. So the allocations can be negative. I can sell things as well as buy them. Okay, so the same type of problem as before, risk and return. This is our array plot showing the covariance matrix. Now, what I want to do here is the unit price for each of the 4 stocks is $1. I've got a maximum of 2,500. I want a return of at least 1,000. So the return value, which we've specified up here, get rid of that. So the return value here, this is mu. Okay, basically this is sigma or R. And so it's going to be quadratic optimization again. With our capital constraint, our return constraint, and a minimum stock value. And the X here will be whether or not we invest in each of these 4 possible stocks. And we can solve that. Okay, so notice X is a vector. And it says, basically, we're going to buy these amounts of everything except for the second one. And so we can substitute that in and find out what our return is. Now, let's include an additional risk constraint. So everything's the same as before, except the risk has this upper bound. All I do is include this additional one. And we find that you get pretty much the same result as before. The total, so in fact, your total return remains the same. But what happens when I introduce short sale? So the same problem all over again. But what's happened now is that I don't have the previous constraint we had up here, which was that the minimum value for a stock had to be 0. That's removed. So we've got quadratic optimization on the risk with the same constraints. We've put the 2 together now. This is the maximum I can spend. This is my return, must be at least $1,000. X is a 4-dimensional vector. And this is what we get. So remember, we didn't buy the second one. Now we're going to sell it. So obviously, it's not a good stock, and we're trying to get rid of it. So what is our overall return here? It's less than it was previously. And the same type of situation will hold again. If I introduce the upper bound on the risk, okay, as put all of these in, then what you can see here is that the constraint value for T is actually going to be so high that it essentially has no effect. All right, and so we get pretty much the same value as before with the same overall profit. This last problem is different. And this last problem I do want to concentrate on just a little bit. So normally when you're going to invest in stocks, you have a lot to choose from. And the central question is, should I buy, so you have something like the S&P 500. There's a lot to choose from. Which ones should I choose? Essentially, what you want to do is choose only a fraction of those stocks. So in this case, let's limit it down to there are 20 candidate stocks. I've got the mean return, expected returns for all of the 20. And I've got the 20 by 20 covariance matrix, generated the same as before, this time for 20 stocks, 6,000 simulations. And we get a much prettier picture this time. So there's going to be 2 variables here. One is going to be the percentage of our investment made in each stock. Okay, this is WI. But there's also going to be a decision vector, whether or not I invest in that stock. Okay, so it takes a value 0 or 1. let X be that 20 element or 20 vector, length 20 vector. Okay. Now, altogether, only 6 stocks have to be chosen. So the sum of the decision variables has to be 6, where X lies between 0 and 1. Essentially, it takes the values 0 and 1. Our weight constraints, so each W is going to be upper bounded by X. Remember, X takes a value of 0, 1, and W is a proportion. And also, the total of the W must be 1. So what I'm trying to do here is minimize the risk, and minimize the negative return is maximizing the return. It's a function now of 2 vectors, the allocation vector, W, and the decision vector, X. They're both vectors of length 20. And I'm choosing, this can go in for quite a while here. So I'm choosing a very small tolerance, 10 to the minus 12. Okay, so which stocks should I invest in? So let's find their position. I'm going to go into X, put in the result, and look for all of those that have the value 1. These are the ones I purchased. So the first 8th, 10th, and up to the 20th, those are the ones that I'm going to invest in. And so having made those stock picks, substitute in the results for W and X and tell us what the weights are. So for those 6 stocks, these are the weights. And this now is, you can see that the weights are just a little fractionally over our 100%. If we include the risk constraint S, all right, we can include, so the objective now is not risk minus return, but the upper bound. And we've put in this with the others. We've now got 3 vectors we have to solve for: the weight, the decision variable, and the upper bound variable. All of them are vectors. And again, I can get the position of the ones that I'm going to invest in, which I think is pretty much the same as before. Yeah, it is. So, and I get the same profit. So this upper bound, yeah, you'd have to make it more restrictive in order to get a different result. The one thing I did want to just go on, so you can read this later. This is more about company profits and the use of linear optimization. Sticking within the portfolio idea, however, let's now go to that idea that I've got the S&P 500, but I don't want to buy all of the 500 stocks there. So I choose the largest 50. Which of those should I invest in? Now, to really do this properly, just like beforehand, when we were choosing 6 from 20, I'm choosing 50 from 500. But in my previous problem, I had the covariance matrix for the previous 500, and then I would have to have a massive decision vector, and the whole thing gets very hard. So what to do? We can use a theorem, you know, basically from pure mathematics, from studying integers, and it has to do with random matrices. So there is a particular distribution called the Tracy-Weedham distribution, and it basically says this: suppose I have a random matrix. Then if you have a random matrix, then the eigensystem, the eigenvalues and the eigenvectors are also random. So we can ask about what is the largest, in fact, what is the standardized or normalized largest eigenvalue. Then its limiting probability distribution will always go to the Tracy-Weedham distribution. And in the case of what we're dealing with, because we got covariance matrices, it's going to be Gaussian orthogonal, so a Tracy-Weedham distribution whose parameter is 1. So we don't have to be worried about you know, doing a massive inner product calculation here. Let's load down the 50 values, look at their, so we're basically looking at their returns here. There's 50 of them, and this is their price history from 2000 up to whenever it was that I loaded this value in. So the correlation matrix is now going to be defined by this. This is the definition of correlation. And so you think, well, I should just be this. But what we're actually looking at is the estimated correlation. And so we have to include this factor. All right. We know everything we need to know about the Tracy-Weedham distribution. So I now work out what is, but from the distribution, I now know what the mean and standard deviation is. And I can then go back and look and say, what are the eigenvalues associated with this correlation? What I want is the largest of the eigenvalues, and then I standardize it. Let's call it X value. Okay, now remember, we're dealing with 50 of these things here, and I can ask myself then, using this, the Tracy-Weedham distribution with parameter value 1, what is the survival function? In other words, what is the probability? We're putting in a hypothesis test here at the extent to which it will survive. A small p-value then indicates the data is unlikely to be uncorrelated. In other words, small p-value means it's going to be highly correlated. Then you say, hold on, okay, this definitely indicates that this thing is highly correlated. But weren't we really concerned about lack of correlation? Yes. That was when we knew exactly what we were choosing from. Here we're in a situation that I want to replicate what's happening in the S&P 500. So I want to choose 50 stocks that replicate the behavior of the S&P 500 and therefore are going to be correlated with its overall behavior. So this is telling me, yes, indeed, this thing that is associated with the maximum eigen value is going to be the one which is most highly correlated. We can go into this a little further and say, let's look at the first 5. And we only have to go that far before we find that the first 5 are highly, 4 are highly correlated, here all the way up to here. And it's the 5th one which is highly uncorrelated. That's when we're getting into it no longer matters. Okay, so the highly correlated eigenvalues are these first 4. All right, now I take the dot product of those with the values for the 50. So I'm getting, this is a matrix, this is a vector. So I'm getting basically 4 vectors here. This will correspond to 4 portfolios. Okay, and this is clearly the, if we go in and look at this, which is the first one, so we're going to look at this. What we find is that when we go in and look at the weights, which are publicly available from the Standard & Poor's side, about how much is invested for how much each of these 50, what proportion of them go into the S&P 500, and now compare this, you'll find that this minimally correlated portfolio is the one that is closest to the market-weighted fund. So we can then use results from statistics, and this is a very important result, by the way, that essentially is telling us which of the 50 stocks to choose and how to allocate them in such a way that we're going to get something that replicates the S&P 500. And you might ask, why would I want to do that? Because the S&P 500 is an optimal portfolio. Any of the large indexes are optimal portfolios. That's what, say, Vanguard, the whole industry of investing in ETFs and indexes is all about. They're already optimal portfolios. Whatever hedge fund investors tell you, it's basically rubbish. Because if you actually talk to the managers of hedge funds, they never invest in hedge funds. They only invest in indexed portfolios.